Enjoy the rest of our programs. Have a good morning. Once again, I am Praise Bell Rismond Labi.
It's your lifestyle, leisure, and business radio.
You're tuned in to Zed 101.9 FM, your lifestyle, leisure, and business radio.
Our quest to redefine
exited an IMF program with optimism. We have been there before, and history has a way of humbling countries that forget too quickly. Now, let me take you back a bit. In the early 2000s, I mean, I was very young, but I've read about it. In the early 2000s, Ghana implemented some reforms under IMF-supported programs designed to stabilize the economy. Now, at the time, the country was widely praised. Inflation had declined significantly. Economic growth was improving. Investor confidence was rising, and Ghana benefited from debt relief under the EPIC initiative. Now, the country later accessed international capital markets and issued its first Eurobond in 2007. And there was excitement, real excitement actually. And many people actually believed that Ghana was entering a new era, an era where dependence on IMF bailouts would become history. But then slowly things began to change. Government expenditure started rising rapidly, especially around election periods. Public sector wages expanded significantly after the implementation of the single spine salary structure. And there was also a lot of things, but revenue mobilization struggled to keep pace. And so deficits actually widened, borrowing increased, and over time, Ghana became increasingly dependent on debt, and not just domestic debt borrowing, but Eurobonds as well. Now, the dangerous part is that a large portion of those borrowed funds did not necessarily go into productive sectors that are capable of, generating some long-term growth and revenue. Instead, debt servicing costs began climbing sharply. And then came another pressure point, the cedi. There was high import dependence, external shocks, and a weak exports competitiveness. All of these things actually place enormous pressure on the currency. And the depreciation of the currency fed directly into inflation and rising living costs. And then, of course, we also saw doomsday between 2012 and 2015 thereabouts. Ghana's power crisis disrupted businesses, reduced productivity, weakened investor confidence, and even slowed growth. And so by 2014, the warning signs were impossible to ignore. Inflation had climbed about 17% at the time. The cedi had also depreciated sharply. Fiscal deficits remained dangerously high. Public debt was rising rapidly, and investor confidence weakened significantly. And then eventually, we had to return to IMF again in 2015 under another extended credit facility program, which was worth approximately $980 million. Now, think about that carefully. A country that had once exited an IMF program with optimism, returned again within a few years because the underlying discipline could not be sustained. And that is why today's conversation matters, because exiting the IMF is one thing. Staying stable afterward is another thing entirely. And perhaps that is a real national test before us now. Can Ghana sustain economic stability without another bailout? Not for 1 year, not for one election cycle, but sustainably, consistently, responsibly. Because macroeconomic recovery on paper and economic relief in people's lives are not always the same thing. Yes, inflation may be easing statistically, but many households are still struggling with the cost of living. Businesses are still dealing with high operational costs. Access to credits remains difficult for many SMEs, and young people are still searching for jobs. Also, many ordinary Ghanaians are asking a very practical question: when will this recovery reach us? When will this recovery reach us? Because economies are not judged only by investor presentations and macroeconomic indicators. They are judged by whether ordinary people can breathe again, whether businesses can expand confidently, whether families can plan without fear, whether entrepreneurs can borrow without being crushed by interest rates. And perhaps the most sensitive question of it all, or of all, is that have we truly learned the lessons from the past? Because our economic recovery in this country has shown as a recurring pattern. Periods of stabilization followed by periods of indiscipline, especially during election cycles and all of that. And this is where the conversation becomes uncomfortable. Many economists actually argue that one of the biggest challenges has not necessarily been the absence of good policies. We have the policies in place. It has been the inability to sustain discipline consistently across political cycles. In simple terms, What I mean is that we often behave well when supervision is present. But the real test begins when the supervision reduces. And that is why many analysts are watching this IMF transition very closely, because Ghana is now moving towards what they call the policy coordination instrument, essentially shifting away from direct IMF financing into a framework that is focused more on policy coordination and monitoring, which means the question becomes, can we maintain the discipline without the pressure of a bailout hanging over us? Can government resist excessive election-related spending as we get closer to 2028? Can borrowing remain sustainable? Can we build an economy that depends less on imports and more on productivity? Can institutions enforce fiscal responsibility regardless of political pressure? Now, these are not abstract academic questions. These are real-life questions with real-life consequences, because when fiscal discipline breaks down, ordinary people feel it first. At the fuel pump, at the market, in transport fares, in school fees, in rent, and for businesses, instability creates uncertainty, because what you will see is that investors will begin to hesitate, expansion will slow down, confidence weakens, planning becomes difficult, and no business is able to thrive comfortably in an unstable macroeconomic environment. And yet, despite all of these things, there is also reason for cautious optimism, because Ghana's current situation is not exactly the same as before. The country has undergone debt restructuring. We've seen, fiscal controls are reportedly tighter. There's greater awareness about the dangers of unsustainable borrowing and all of that. And perhaps, most importantly, many Ghanaians are more economically conscious today than ever before. People are paying attention. People are asking questions. People understand that macroeconomic stability is not just an economist conversation anymore. It affects every single person. And maybe that awareness itself is part of the opportunity. But then again, awareness alone is not enough. We know that discipline matters, institutions matter, policy consistency matter, and that is why today's roundtable is very, very important, because we are moving beyond the headlines and the political talking points. Our topic this morning is beyond the IMF. Can Ghana sustain economic stability without another bailout? Can we sustain economic stability without another bailout? And this is not just about whether Ghana exits the IMF program. It is about what happens after. Can the gains be sustained? Will investor confidence remain strong? Can macroeconomic recovery translate into real opportunities for businesses and households? And what policy choices must we take or must we make now to avoid repeating the cycle? And I'm going to be joined by two individuals, a financial analyst and a research officer, a senior research officer at Lauros Africa Securities. And together we'll examine what this IMF transition really means for businesses, for investors, and for ordinary Ghanaians. Because, perhaps the greatest lesson from Ghana's economic history is that exiting the IMF is not the final achievement. Sustaining discipline afterward is actually the real challenge. And that is what we'll be talking about this morning on our roundtable discussion. So please don't go anywhere. You can join the conversation on our social media platforms. We're streaming live on Facebook at ZFMGH and on YouTube at Z Multimedia. Please feel free to visit those platforms and drop a comment under the live stream. We'll read them for you. Also, you can take note of our number. Send us a WhatsApp on 0544321019, 0544321019, and we'll read your messages for you. And so that'll be all for our business brief segment. All right, thank you very much. Lois Amano is ready to bring us transport today this morning. Lois, good morning.
Good morning, Neem.
How are you?
I'm good. How about you?
I'm very good by God's grace. How was your weekend?
My weekend was amazing, but it looks like this morning everybody's down because of the rain
weather,
yesterday.
Yeah.
Yes.
As for Ghana, when it rains,
and
like
especially when it's Monday, everybody's feeling, should I go to work? Should I sleep?
but
Yes.
you don't have an option.
I don't. I have to be here. The work must continue.
Right, of course. I mean, you need to bring people transport today. So
Exactly.
you can't stay home.
Exactly.
All right. Anyway, tell us how our routes are looking like.
Okay, so we'll start with the flight schedules.
Okay.
And then we'll go to town and see how the traffic is looking like in town. And then we take some trending news in the aviation sector. So I'll just dive right in. I'll start with the flight schedules, and we're starting with Passion Air. So Passion Air Accra to Kumasi flight schedule this morning at 6:20 a.m., 8:50 a.m. and 11:20 a.m. And the afternoon schedules are 1:50 p.m. and 4:20 p.m. And the evening schedule is 7:20 p.m. and it takes 40 minutes to get to your destination. Now, Accra to Takoradi Passion Air flight schedules are 6:20 a.m. for this morning and 4:20 p.m. for afternoon, and it takes 50 minutes to get to your destination. Now, Accra to Sunyani flight schedule for today, Passion Air, 9:10 a.m. and it takes an hour to get to your destination. Now, there's just one flight schedule for Accra to Sunyani today, and Accra to Wa flight schedule is 9:50 a.m. and it also takes 1 hour 40 minutes to get to your destination. Same for Accra to Wa as well. There's only one flight schedule for today. Now, Accra to Tamale flight schedule for today at 6 a.m. and the afternoon schedule is 12:20 p.m. and 4 p.m. and it takes 1 hour 20 minutes to get to your destination. So that is it for Passion Air. Now let's go and look at Africa World Airlines. Now, Accra to Kumasi flight schedule for Africa World Airlines this morning at 6:20 a.m., 8:40 a.m. and 9:40 a.m. and the afternoon schedule 12 p.m. and 12 p.m., 2:20 p.m. and 4:40 p.m. and the evening schedule is 7 p.m. Now, Accra to Takoradi flight schedule for Africa World Airlines 7:20 a.m. for the morning, and then the afternoon is 4:30 p.m. and it takes 40 minutes to get to your destination. Now, Accra to Tamale flight schedule this morning at 6:30 a.m. and 9:30 a.m. and the afternoon schedules are 12:30 p.m. and 3:30 p.m. and it takes an hour to get to your destination. So that's it for their flight schedules. Now let's look at how traffic is looking like in town. So this morning, if you're using the Dome Road, kindly be aware that from the KFC going down to the Atomic Runabout, there's traffic on that road, and it goes down all the way to the Hacho Road. So if you're using the Dome Kwabenya Road coming from Dome going towards Hacho and Atomic, kindly know that there's a bit of traffic on that road this morning. There's also a bit of traffic from Medina going towards Adenta. If you're using the Adenta Medina Road this morning going towards Adenta, kindly know that there's traffic on that road. There's traffic around the Wicks and Bundles Hub going towards the West African Senior High School and towards the KFC on that road. There's a bit of traffic there this morning, so kindly be aware of this. And there's also a bit of traffic on the JJ Rawlings Avenue this morning. If you're using the JJ Rawlings Avenue, kindly know that there's traffic on that road this morning. It's around the Shell fuel station and going towards the Edge Closet. There's a bit of traffic there. There's also a bit of traffic this morning on the Ring Road. If you're using Ring Road this morning, going towards the Absa Bank, it actually starts from Fidelity Bank and goes down to Absa Bank. So if you're using the Ring Road this morning, kindly be aware that there's traffic on that road. There's traffic around the Fidelity Bank, goes down all the way to Absa Bank. So kindly take note of that. There's also a bit of traffic on the La Paz Road this morning. So if you're using La Paz going towards Papaya Fast Food or La Vista Home Decor or even to the La Paz Community Hospital, kindly know that there is traffic on that road. The traffic on the La Paz Road is a bit tight this morning, so kindly take note of that. There's also a bit of traffic on the Achimota Road this morning around the Achimota Old Bus Stop. So if you're using the Achimota Road this morning going towards the Old Bus Stop, kindly know that there's traffic. There's also traffic around the OKS Herbal and Wellness Hospital. So if you're using that at Achimota Road this morning, going towards the old station bus stop, or you're going to the OKS Herbal and Wellness Hospital, kindly be aware that there is traffic on that road. There's a bit of traffic also on the Independence Avenue. So if you're using Independence Avenue this morning, kindly know that there's traffic on that road. There's also a bit of hold up on the Graphic Road this morning around the Nissan showroom. So if you're using the Graphic Road around the Nissan showroom, kindly know that there's traffic on that road. And there's also a little hold up on the Okponglu Shiashi Road going towards Accra. There's a bit of hold up there. So if you're using the Okponglu Shiashi Road, you're going to Accra, kindly be aware that there's traffic on that road. So that's the traffic situation in town. Now let's take some trending news in the world of aviation. So the Ghana Civil Aviation Authority has held a grand final dinner to climax its month-long 40th anniversary celebration, with calls for continued collaboration, innovation and commitment to aviation safety in Ghana. The event was held at the Kempinski Hotel and was held on 16th May, this Saturday, at the Kempinski Hotel, and it brought together stakeholders from the aviation industry, government officials, and individual guests were also present. And the Ministry of Transport and the Ministry of Roads, the ministers were there as well. The Director General of the GCAA, Reverend Stephen Wilfred Arthur, in his welcome address, thanked guests for joining the authority's celebration and urged individuals and the government to help boost the aviation sector and make it more safe for individuals and the country as a whole. Now let's move to another trending news. So Nigeria Airline has commenced operations to 2 new routes as part of its continued commitment to expanding connectivity, enhancing passenger convenience, and strengthening regional integration across West Africa. The initiative begins from May 18, that is today, 2026. The airline will commence daily flights between Owerri and Abuja, creating a direct flight connecting the two states between the southeast region and the federal capital. Now, the route is expected to serve the growing travel needs of businesses, professionals, and government officials, families, students, and leisure travelers who require dependable and comfortable air transport between both cities. The introduction of the daily Owerri-Abuja flight is a reinforcement of the Nigeria Airlines' growing domestic network and its dedication to improving accessibility within Nigeria and throughout the country. So that is it for transport today.
All right, thank you very much, Lois, for bringing us transport today this morning. You're still tuning to the Business Breakfast on Zed 101.9 FM with me, Nitrebi Hammond. And this morning, we're going to bring you a market trend segment very soon, and then we bring you the roundtable discussion. Please don't go anywhere, stick and stay. We'll take a quick music break. When we return, Emmanuel Barton joins me for our market trend segment. And enjoy Walila by Perez Music. We'll be right back. its targets by nearly 35%. We also know government actually sought to raise 4.3 billion Ghana cedis, but received bids worth almost 5.8 billion Ghana cedis, eventually accepting more than 5.4 billion Ghana cedis. Now, interestingly, even with this renewed investor appetite, interest rates continue to rise across the yield curve, especially on the longer dated bills. And so, I mean, very interesting questions. What exactly is driving this rebound? Are investors becoming more confident in our economic outlook, or are they simply chasing higher returns? And what does this even mean for government borrowing and the fiscal plan for the coming months? And that's exactly what we are talking about this morning. Emmanuel Boateng, our in-house economic analyst, joins me over the phone lines for this important conversation. Iman, good morning. How are you?
Yeah, good morning. I'm doing very well.
All right. I hope you had a good weekend.
You can say that. Yeah, it was good.
All right. We thank God. Okay, so let's get into our conversation this morning. My very first question to you is whether the 35% oversubscription is a true sign of renewed investor confidence, or maybe just some excess liquidity chasing safe assets.
Thank you so much. And of course, good morning to our cherished listeners. You know, I have before me this morning the results of tender 2007 that was held on the 15th of May for Government of Ghana securities to be issued, of course, today, 18th of May. And per the results before me, certainly there is no way that government was going to fall below its target. And why do I say so? The previous tender, government received 7.8 billion Ghana cedis, from the public, and sold 6 billion or 6.1 billion Ghana cedis. And so if you look at how much government was able to achieve, 6 billion. And as you may know it, this was also an oversubscription. And in this very auction, the government's target was 4.3 billion. So pay attention. Government achieved 6 billion in the previous, and the new target is 4.3 billion. And so, particularly and consistent with the narrative, this is well within the threshold of tenders that come in for government to accept. And so I will not particularly be surprised, even without the result, if government is able to meet and exceed its target.
Right.
Which is exactly what we do see. So 4.3 billion target, and government is able to raise well above that, way above that. And so you could understand the dynamics at play here. In fact, I think government is able to achieve more than 5 billion itself. And that is it. So I can't say that, yes, the oversubscription is happening partly because there is some confidence. Because if there is no confidence at all, people are not going to come. But I don't think it's purely driven by optimism, especially optimism around our macroeconomic fundamentals, Because typically in economic environments where there are uncertainties, investors often gravitate towards short-term government securities, because that is more or less a place where you can park your car safely without, any harm being caused to it, especially with respect to your liquidity. And so what we are likely seeing is a combination of improved sentiment and liquidity chasing. You see, banks and institutional investors may have excess funds they prefer to place in risk-free government instruments rather than extend them to the private sector. But I must say that true confidence would reflect not just oversubscription, but sustained demand at stable or falling yields. We also saw what happened to demand when the yields were falling. And this current rising yield pattern suggests caution is still very much present in the market. So I think this is better described as a liquidity-supported rebound rather than a full confidence recovery. Yeah, more or less.
I see. But why is government accepting more than its borrowing target despite the already high fiscal pressures?
Well, for me, it's one thing to even go by the target they set for themselves, especially when I graph their actual performance over time, which I think so much that this is well within that range. More precisely, this is just within the range of amounts that the government has been accepting or selling, in recent times. But traditionally, when the government accepts more than its target, it often signals active cash flow management, rather than strict adherence to auction plans. Because there are fiscal pressures, expenditure obligations, refinancing needs, all of that are there. Today that you are auctioning new bills, today is also a day that you are paying people whose bills may have matured. I don't know if you get the point I'm making.
Yeah.
So you constantly need money. And that can force them to be flexible and not really rigid or strict about how much they need and the like. See, when market conditions have improved, sometimes the government takes advantage of that strong demand window to build its buffers, because you never know when the evil day will come, when the investors may not really have money to put in the T-bill market.
Yeah.
But this strategy itself carries some risk, because when you borrow beyond your target, especially in a high-yield environment, that will increase your debt service costs over time. Of course, I know the view is already out there that this interest rate currently that we do see is way below as it were what we saw 2 years ago, 3 years ago, and the like. But don't just look at the interest on T-bills. Look at inflation at 3.4. Look at the, how do we call that? Look at the monetary policy rate, which is also lower than the 30s and 29s that we used to see back in the. So while in the short term it may be able to address liquidity constraints, it can also deepen our medium-term fiscal strain if we do not manage this thing.
I see. Now, away from that, one of the issues people have been talking about is the yields and the rising yields. I'm curious, are they a warning sign or a healthy correction in the market?
Well,
hello?
Yes, I can hear you.
Hello, Emmanuel?
Yes, can you hear me?
Yes, I can hear you now. Yeah.
Yes, please take the question again.
Yeah, so I'm asking whether the rising yields that we are seeing are a warning sign or a healthy correction in the market.
Oh, traditionally, this is a healthy correction, because the way in which the yields fell, and the only conclusion we can comfortably come to is that the market has to correct. And I think that what we are seeing, or we've seen over time, is correction. Because if you find rising yields, falling yields, you see, like that switch, you've seen that over time. And typically, you can explain rising yields in many ways. It is either the fact that, things fell so much that now it has to correct itself. And also the fact that, maybe the investors are pricing the risk that is associated with the instrument better now. So you can do all of those things, you see. So it could be any of the two. But in this case, I think it's correction.
I see.
It's correction. And as you can see, investors are not really fully convinced about locking in their funds into longer term instruments. Despite the slightly higher returns that are being offered, especially when you compare it to what we have seen in quite recent times now. And when you look at the yield curve, there is still some level of uncertainty in it.
Okay.
And for the government, that will create some refinancing as it were, challenge for them. Because as more debt needs to be rolled over frequently, that will increase the exposure to market volatility.
Right.
Yeah. And so I think that altogether, I think this is more of a correction than a case of maybe, as it were, renewed confidence, something else you may even call it. It's more of a correction.
I see. But would you say that inflation and macro stability has improved enough to justify the current investor behavior?
Well, there has been some signs, of relative stabilization in our macro indicators when you compare to the past, where we saw some strong volatility. And that often encourages re-entry into government securities market. But we must also note that investor behavior suggests that confidence is still conditional, and the preference for short-term instruments and rising yields actually demand some level of, as it were, confidence, which is a clear indication that inflation is still lingering and there are still currency risk concerns. So if macroeconomic stability were fully restored, we would expect stronger long-term participation in declining yields. But if that said, typically in the CBO market, and based on historical performance and all of that, we do know that the Ghanaian investors typically prefer the shorter term bills than the longer term ones.
But what risks does higher domestic borrowing at rising yields pose to our debt sustainability? And I ask that because a lot of people have raised concerns, first of all, about the way government is borrowing domestically. And some people say that it is not a problem at all. I mean, it's better than going to the external markets and all of that. But at this time, we are seeing that the yields are rising. What does that, what is the effect of that on our debt sustainability as a country?
Well, let me start off this way. You know that higher yields to you means higher interest, but to the government, it means that they have to pay more for the debt.
Yeah.
And that can quickly compound fiscal pressure on them. And it doesn't matter whether or not that borrowing is domestic, foreign, and the like. The interest burden still affects our budget. Now, if...
Hello, Emmanuel. Okay, I think we lost Emmanuel there. We'll try and see if we can reconnect him. Hello?
Then the government...
Hello, Emmanuel.
Yeah, can you hear me?
Yes, we lost you for a few minutes, so maybe you may want to start over.
Yeah, I'm saying that if the government of Ghana continues to accept, bids that are priced very high, or earn very high yields, you see that, and the assets where the government is accepting that, then certainly is going to affect their cost obligation, you see, which is really dangerous sometimes for the government. And so for me, generally, you need to ban, unless, of course, there's a certain data available to the government where, even at the current price, it's still good offer and all of that. That one I cannot tell. Maybe you know. Maybe because as for you, I don't know. You know a lot of things. So maybe you know that they can do that and all of that. But generally, I think that higher yields cost the government a lot. And that would put some fiscal pressure on them. And if they continue to do that, it is going to cost them even more. It's going to be so much expensive for them. And that will reduce the room for developmental spending. And there is also the rollover risk, because if they are accepting it now, a lot of the investors, in fact, they invest in the T-bills for 1 year or even more. But they do it in a very interesting way. They lock in for 90 days, and then they roll it over for, as it were, they roll it over for 4 times, right? And that becomes a full year kind of thing. So that is how it works. So the rollover risk is also there, and the interest rate keeps going up. You can see the cost on the government. So in the short term, I think sustainability risk shifts from external exposure to domestic cost accumulation.
And is that something we should be worried about?
Well, You should. You should. You should, because already you are pricing out the private sector, and if it increases costs, and that is going to reflect in the monetary policy rate, then even the private sector going back to the bank to go and borrow will also cost them more. So we should really be worried.
I see. All right. Away from, let's talk about exactly what is driving the shift in demand. Would you say that, or do you know with some facts, that institutional investors, and by that I mean the banks and also funds, are actually those that are driving this demand shift?
Well, usually yes. Unless, of course, we the retail investors have gathered somewhere and decided to do this. Otherwise,
typically it's the banks, huh?
in terms of how much you are able to even invest in the civil market, it's typically not as much. So unless that is the case, I doubt that the retail investors may be able to do much. But the institutional investors, yes, they are the strongest force to drive over subscription, because banks, pension funds, asset managers, they respond very quickly to yield movement and liquidity conditions. Now, when private sector lending is less attractive or riskier, these institutions will redirect their funds into T-bills, because it's going to give them some safety, some liquidity, and then predictable returns. And there's also some regulatory requirements for them, which encourage them to hold government security. So that regulatory requirement necessarily obligates them to push all their funds into the T-bill market. So the demand surge is less retail driven. I think it's more of institutional. Many of the demand surges are institutional. When it is retail, you know.
But
institutional, you invest no matter the rate.
But could this signal reduce appetite for private sector lending? Due to crowding out.
Well, yes, it's very, very likely. The whole point is this: when the government securities are more attractive, so for instance, the banks, they have been attracted, so that is where they are going to focus. And once they do that, they are going to leave out the private sector. In other words, lending money to them, making funds accessible to them. The money that they would have given to the private sector is the same money that they are using to invest in the people. So, inadvertently, they crowd out the private sector entirely. You see, and that will reduce credit flow to the private sector, especially SMEs that typically rely on bank financing. Now, the opportunity cost of lending will therefore increase because the T-bill yields are going to rise. What I mean is that they are not going to lend to the private sector. The reason is because T-bill yields are up, and that becomes attractive to the institutional investors. And over time, this can slow productive investment and economic expansion. So while governments benefit from the access to funds that comes from the banks, the broader economy may face tighter credit conditions. And this is the classic trade-off in high domestic borrowing environment. Let me say that I'm not saying there's anything wrong lending money to the government, because if you are even a bank or a commercial bank, you are safer lending to the government than to a private person. Because the risk of default is, I think it's in Ghana or in developing economies, is higher for the private person than it is for the government. But when you do that at the expense of the private sector, that is where I do have a problem, because as you would note from the literature, it's the private sector that drives economic growth. And so if they are handicapped, then economic growth will subsequently be handicapped as well. And so lending money to the government at the expense of the private sector and subsequently economic growth is where the real problem is.
Yeah, I see. Right. So the effect is that or essentially what you're saying is that there should be an even distribution, right, of funds between government and the private sector. From the banks.
Fact, you should even lend more to the private sector than to the government. You exist to play an intermediate.
I see. All right. Anyway, a few more, maybe two or three more things, and then we can wrap up. Now, are we entering a phase of expensive stability where borrowing is easier but costly?
Well, it's a good definition for the current trend because demand for government bills is returning, but at higher yields gradually. I know it's not that high, but relative to just the past period is quite high, meaning that stability is being bought at a price. You see, I'm sure you heard so many things about some things. I'm sure you remember they said this was bought at this price, the exchange rate. I'm sure you saw the Bank of Ghana balance sheet and all of those things. Yeah. And it's a reflection of a market that is functioning but not yet fully confident. You see, investors are willing to lend money, but only with higher compensation for the risk that they are assuming. And so there's a form of equilibrium where access improves, but affordability worsens. You see, and that balance can actually persist until inflation expectations and macro risk decline further. So yes, borrowing is becoming easier to access, but I think more expensive for us to sustain.
Okay, maybe finally. So, what does this trend suggest about the next, say, 3 to 6 months of fiscal financing strategy?
Well, I think that over the next few months,
Hello, Emmanuel.
yeah, Nitra.
Yes, I lost you for a few seconds.
Yes, please. So I'm saying that over the next few months, government will likely continue leaning, on the domestic market, especially if external financing remains limited or quite expensive, because a strong appetite for T-bills actually provides a reliable funding channel for the government. However, the rising yields actually, I think that. Hello, Nitabi.
I'm with you.
Okay. Yeah, so I'm saying that over the next few months, the government will likely continue to lean on the domestic market. But the increasing interest rates on the T-bills will likely be their problem because that is more cost to the government, you see. And they are going to be very strategic about what bids they accept, which ones they reject, and so on and so forth. You see that. So I think they are going to be more tactical about their borrowing rather than some fixed long-term patterns on it, you see. And the government also needs the liquidity conditions within the economy to remain supportive. Because where there is no liquidity, where individuals and pension funds, among others, do not have the money, then they cannot invest at all. So you need a very liquidity supportive system to be able to aid you. And that is what we need. Because, you see, oversubscriptions may continue, but volatility in yields are going to affect the cost. And the key challenge will be balancing access with affordability. And over the next phase, it's likely to be defined by available demand but selective pricing.
Okay, right. Any final words, and then we can go.
Well, for me, my final words would be that don't lend money to the government at the expense of the private sector and economic growth. That would kill our economic growth, and we've been seeing that happening. The private sector should really play its role, you see, in growing the economy, and banks must also play their role as an intermediary, and not doing something else that traditionally they are not known for.
Okay, right. Ima, thank you very much for your time this morning. We're really grateful. All right. Okay, so that was Emmanuel Watting, our in-house economic analyst, and this morning we've been talking about the treasury bill market and what exactly is happening there. We're seeing for the second time an oversubscription, after several weeks of weak demand, and Emmanuel says that there are quite a number of things, but he thinks that one of the factors in there, he thinks that it's purely or partly a signal a confidence signal, really. The oversubscription we are seeing is that, and also there are some things that he highlighted. But if you miss any part of the conversation, feel free to visit our social media platforms. We're on Instagram, Facebook, and X at ZFMGH, and on YouTube at Z Multimedia. Please visit and play back the audio. So that will be all for our market trends segment this morning. We're going to get into our roundtable discussion shortly, but we'll take a quick music break, and when we return, we bring you all of that right here on the show. Please don't go anywhere. 101.9 FM with me, Nichwe Bihamon. Exactly 3 minutes after 9. And that was Wara by Kwesi Arthur. Anyway, so we get into a roundtable discussion this morning. Today, like I indicated a while ago, we're talking about something very important. Now, as you are well aware, Ghana is at a very key turning point. We're transitioning out of our IMF supported program and asking a very big question. What comes next? Are we truly on the path of sustainable recovery, or are we simply repeating a familiar cycle with new numbers? Now, on paper, we are seeing signs of progress. Of course, we've talked about easing inflation, some stability in the CD, and improving investor sentiment and all of that. But on the ground, many people, many businesses and households are still dealing with high cost, tight credit conditions and economic pressure that hasn't fully eased. And so this morning, we are going beyond the statistics. We are asking the real question about discipline, about debt, about policy consistency, and whether we are able to sustain the stability without external support. And to help us break this down, I'm joined in studio by Mark Jordan Sika Nate. He is a senior research associate at Lauros Africa Securities, and he joins us in studio for this conversation. We're also joined over the phone lines by Nelson Kujo Kwagbeji. He is a financial analyst, and he also joins us for this all-important conversation. Gentlemen, good morning. Good morning.
Yeah, good morning, and then thanks for having me.
Sika, thanks so much for coming in studio this morning. We go way back. You know, when we're students back in the university, we're both students back in the University of Ghana, and I'm glad to see what God is doing with you all over. I see you on big platforms. It's a pleasure to have you in studio this morning.
Sure, thanks.
All right. And also, Nelson is over the lines. I'm getting some feedback from Nelson's end. I don't know. We'll have to fix that. But maybe we can begin the conversation while I get that resolved. So, Sika, very interesting turn of events. We are told that we are exiting the IMF program, and a lot of questions are on the minds of many people, especially people in the business community and even households, individuals, and all of that. Let me begin with this, and I want us to begin broadly. Looking at the journey so far, looking at where Ghana is now compared to the peak seasons that we saw, inflation skyrocketing to about 54% thereabout, and all of that. How would you describe the journey so far?
I think thank you. That's a very interesting question. I see that given the way it's been broadly defined by many who've been asked a similar question, or colleagues like myself in the space. Right. I mean, we all hear that one thing called recovery. Yeah. And I mean, clearly that's been it. I would say we've largely been in the recovery phase, trying to find our feet and trying to put our economy back on track. Has it been successful? Yes, to a large extent, and I think really that's what it has been, because drilling down to, I mean, on the broader perspective, when you are looking at it from the macro dynamics, right? Moving from about 54 in about 3 years ago, and then looking at where we are right now with latest print around 3.4, and also gauging from, you know, the fact that previous inflation was highly driven, you know, by food prices, and with complement from the non-food side, we see some broad stability across these two inflation components, right? And in terms of growth, it's been quite robust, you know, and on that front. And in terms of our reserves as well, we've been able to, you know, build some ample reserves. And so that's been the story. But in terms of it being complete, I think that's where we are still hanging, whether the recovery is fully complete. Yeah.
So what would you say? What would you say to that? Do you think that Ghana is exiting the IMF program? Are we out of the woods? Do you think we are out of the woods yet?
Yes, I would say we are out of the woods. At least where we were and what took us there, we are out. You know, and that still takes me to my earlier submission where I was trying to compare the macros where we were prior to the IMF and then where we are now. And so clearly you could see we are out of the woods. I went to the IMF with a really depressed reserve levels, really high debt levels, and we also had our currency with very high volatility, at that time. Yeah. And all these fueled into prices, right? Inflation skyrocketed, and I think more interestingly, we also saw interest rates, inflation dynamics feeding into interest rates. Yeah. Interest rates, at a point, government was borrowing on the treasury bill market, even for a 91-day, like around 30%, And that meant that businesses were crowded out of the, credit markets because, if government can offer you about 30%, you go buy the paper, go to bed. You won't need much work to, lend to the private sector guy. But we've seen quite significant turnaround in these dynamics, To put it into perspective, I think at the start of this year, I had my bankers reach out to me for loans and stuff. This wasn't the dynamics back then, Yeah. So I would say that this is what it is. But for me, the completion really, I would term it a strong recovery so far. Okay. However, we still have some way to go, and that makes it partly incomplete. Okay. Yes, because then for it to really truly define it as complete, then you should have some confidence to be able to see it in the foreseeable future. Right. And I think currently when you look at the investor sentiment and the tone on the market, we are still in that uncertain mode whether the recovery is truly complete.
So you're saying that we are partly out of the woods?
Yes.
All right, let me bring in Nelson now. I think I have Nelson over the phone line. So Nelson Kujo Kwagbeji is a financial analyst, and he also joins us for this conversation. Nelson, good morning. You're welcome.
Yeah, good morning, my brother, and thanks for having me. And good morning to my brother in the studio.
Good morning, Nelson.
All right. Do you guys know each other?
Yeah.
Oh, okay. All right. Since you're in the same space here, it's understandable. All right, but Nelson, I was asking Mark Jordan a while ago whether, how he would describe the journey so far with what we saw in terms of our inflation, our macroeconomic numbers, and all of that in previous years, and how would he describe the journey so far? I want to hear from you on that same score.
All right. Thank you very much for having me. Well, the journey has been interesting, looking at where we were, what actually took us to the IMF, what we have done within this period, and what the current status of the economy is. We can only say that the journey has not been easy, but with resilience and commitment from the fiscal and monetary authorities, we've been able to turn things around as a country. If you recall at the time, it was purely as a result of fiscal mismanagement that actually took us to the IMF. Even though the politicians are actually blaming it on externalities, looking at it purely from an analyst point of view, it was actually the fiscal mismanagement that actually took us to the IMF, because as at that time, we overborrowed, and just as my brother said, even the 91-day treasury bill, we had to, because now you are risky, investors are demanding for a premium. And government was borrowing even 91-day, treasury bill at over 30%. Yeah. And that tells you that then there was no confidence in the economy. The economy was rated as a junk economy. And so we had to go to the IMF in order to inspire a certain level of credibility, policy credibility, and confidence within Ghana's economy. And you must know that most of these offshore investors, once they know that you are under an IMF program, they get some level of comfort. So, I mean, that comfort actually brought some level of stability and policy credibility into the economy. And since then, we've been able to, turn things around. Now, going forward, the question that we need to ask ourselves fundamentally is, how do we sustain these gains that we have made, number one? Number two, how do we prevent ourselves as a country from going back to the IMF? You see, because once you go and exit, next time you go and exit, it means that when the headmaster is not in town, then the students are, jumping exit. You get it?
Right.
And so once the headmaster is not there, then we start doing things the way we used to do it. Over financing of political campaigns during the election year, we overspend, and then we come back after the election to come and correct the mess that we created in that particular election. So going forward, the question basically has to do with how do we sustain the single-digit inflation? How do we sustain the currency stability? How do we continue to build our reserve to support, the currency? How do we grow the economy to generate jobs? How do we rake in enough domestic tax revenue? Because see, if your expenditure is 20 and your estimated revenue is about 10, it means that you have to go and borrow to finance your budget. And so your domestic tax revenue mobilization is key post-IMF. In fact, I was saying it on another platform that if we fail to tax the informal sector to rake in the needed revenue domestically, then our chances, because you can be fiscally prudent, I will not spend it, But once you are not raking in the needed tax revenue to support the expenditure, then we may end up going back to the IMF. However, with the kind of demonstration that we have seen from the current finance minister and the governor of Bank of Ghana, some of us as market players, we have the confidence that we may not get there again because, some of these economic situations are highly political in this country. Party A would say, who was able to take the Ghana to IMF? This one will say, during my time, I have not been able to borrow externally, but I've been able to do this. And so this whole IMF story is highly political in this country. And so we believe that the current finance minister and the governor will not sit aloof for the gains that we have made to, be eroded.
Right. Okay. We'll look at some of the specifics very, very soon. But what would you say has been the most significant shift since we entered the IMF program?
Well, if you look at the macro fundamentals, they have significantly improved. Okay, if you look at them one by one, you could see that the status of those indicators as at the time we went to the IMF and the status of those indicators today, there has been a significant shift. And also, in terms of policy direction, we have seen some level of a shift in terms of fiscal prudence. The government has been very prudent as far as the expenditure control mechanisms are concerned. And so that has actually culminated into some level of, savings to the government. Because if you are able to control your expenditure and even maintain the same level of revenue, then some way, somehow, you are good to go. So I would say in terms of the macro fundamentals, there has been a significant shift. In terms of government policy initiatives too, for instance, if you look at the GANRAP, the Ghana Accelerated Reserve Accumulation Program. It's a very brilliant and fantastic idea because as soon as you continue to build your reserve, what it means is that you are putting flesh, you are putting muscle to your local currency, your functional currency. But once you begin to deplete your reserve, it means that your currency will tend to become skeletal. And so that policy is a brilliant one because now we are the leading producer of gold in Africa. And so if we take advantage of that to build enough reserve, you will realize that in the medium to long term, we will have a city that is stable, that can support the economic growth and development. So in terms of shift, I would say the macro fundamentals have done very well, and also government-owned policy interventions are really working in their favor.
But just to stay on that a bit further, what matters more, especially at this time, is it the macroeconomic numbers or the lived experiences of the Ghanaian people and also businesses?
All right. I think this is not the first time you are asking this question. In other words, those macro fundamentals that analysts are saying, oh, the economy is good, is it really benefiting, the ordinary Ghanaian on the street? Yes, if you look at it generally, some of these macro indicators may not immediately readily transform into, gains or benefit for the ordinary citizen. But we have to look at it, on case-by-case basis. For instance, if you take lending rates, okay, I've always been saying that when you choke SMEs, private sector, with high lending rates, they may not grow because you can't go to the bank and borrow at a rate of 30%. And let's say you take 1 million, end of year, if you are using a straight line amortization about 300,000, which business will you do in Ghana and be paying 300,000 annually as interest or finance cost? And so if you look at the interest rate at the time and compare it to the interest rate today, you see that there has been a significant, shift. Right. For instance, Ghana reference rate for this month, I think it's around 10.2%, which means that gradually, we are expecting the lending rate to further dip. Again, we have a governor who is more fixated on achieving single-digit lending rate. So it means that once lending rates are coming down, business confidence is also bouncing back. Again, if you look at consumer confidence, inflation is at single digits. So the rate at which prices will increase, we expect that to be lower. And that is going to enhance, the disposable income or the purchasing power of consumers. And that will bring back some level of consumer confidence. And so I would say, on case-by-case basis, we can draw the conclusion that the macro fundamentals are yielding to the benefit of the economy.
All right, so let me come in studio and come to Mark Jordan. Now, Mark Jordan, now we are transitioning, from the program. Out of an IMF program. In simple terms, what does this exit really mean for our economy?
Yes, thank you for that. So, first, we had a challenge that took us there. So if we are exiting, it gives some sense that we've been able to deal with that challenge considerably, And these are the challenges.
I like the word considerably.
Yes, considerably. I think Nelson touched on these number of challenges. So I will not go back to, stress on them. Right. So that's what it means, one. But on another level, right, what it actually means is we are now going to look at internally driven discipline, fiscal discipline, rather than like something that was fueled by an external dynamics, because when you go to the IMF, you are given some parameters, and key benchmarks that you have to meet. And what we had initially, the 3 billion program was finance back, you would have some budgetary support, So because of what you would expect from them, it puts you on your toes to, deliver on the benchmark that you two have agreed as parties. So moving out of the IMF, first, the positive is that considerably we've been able to deal with some challenges. Right. The other side of it also is that we are now going to tell ourselves that we'll do ABC. For instance, keep our primary surplus, around 1%. Okay. And then we should be able to deliver that without anyone, being on our neck to do so. So largely that's what it means. And I think the third would be that, government has relief from, certain things certain dynamics that were capped, For instance, employment in certain public segments, public sector, and certain parts of the public sector was capped because of the program. So I think now government can now analyze its wage bill and consider whether it would want to, employ some people, on that side.
So it's going to affect jobs. It's going to affect several parts
Exactly.
of the economy.
Yeah.
Let me go back to Nelson. And Nelson, I want you to hear your thoughts also. I mean, Mark Jordan earlier on said that he thinks we are almost, or maybe partly out of the woods. I also want to ask you the same question. Do you think that, exiting the IMF automatically means that we are totally fine or we are stable now?
No, it doesn't mean we are totally fine. It doesn't mean we are totally, out of the wood. One of the major problems of this country has always been leadership. Because in as much as we are thinking of macro fundamentals, which are quantitative in nature, we must also look at the qualitative aspect of it, because you cannot do analysis based on only quantitative data. The question is the tone at the top, the leadership. Do we believe as analysts that, leadership will maintain whatever stage that we are now going into the future? Do we presume or assume that, okay, in 2 years' time we are going to have elections, so we are going to derail all the gains that we have made? So these are the relevant and important questions that we have to be asking ourselves. We are not totally out of the wood. You will even realize that the relief issued by the Ministry of Finance, there is an extension of the program, but this time around it's non-financial. In terms of technical assistance, in terms of technical competence to assist, the managers of the economy as to which direction to maintain. So if we are actually completely out of the wood, I don't think government will extend the program, non-financially. And so I will agree with my brother that yes, we are not out of the wood yet, but going forward, discipline is going to be key. Fiscal discipline is going to be key. Will be very, very important in terms of where we are now and how we want to go into the future from here.
Right. I think Nelson just touched a bit on, and I'm talking to you, Mark Jordan. So Nelson just touched a bit on something that makes this particular exit different from previous ones. I know we've been there before. We've exited and had to go back and all of that. What do you have to add to that? This particular exit, what makes it different from previous exits from the IMF program?
Okay, I think when you read from the exit report published by the IMF, they are clear on the fact that very key benchmarks have been met by this program, and that makes the exit to some extent healthy for Ghana. And so I think it's a key standout compared to the one we exited around 2019, which was will I say, was a negotiated exit, at that time. Right. And I think certain key benchmarks were not fully met compared to what we are looking at in this particular exit. And I think that's what gives investors some confidence, right? When you check the macros, like Nelson mentioned, and in terms of reserve, we are exiting this program, right, with inflation even lower below the BOG's medium-term target.
Right.
And that creates some buffers, at least within the next months ahead of us, should we even face some challenge, right? So I would say that what makes this quite different is the fact that we've been able to build considerable buffers.
Right.
Even when you check from reserve position, the last latest summary of economic data released by the Bank of Ghana in March, right, showed our reserve for February about 14 billion. And that meant we had an import cover about 5 billion, right? And so that creates some ample buffers against the medium-term target of 3 months of import cover. You get it?
Yeah.
So for me, in some, we're exiting this one with some considerable buffers. But yet again, like Nelson mentioned, the tone at the top and then discipline and leadership is really the concern going forward. Yeah.
Exactly. So I was going to come to that. What exactly do we need? I mean, can we realistically maintain the stability? From the look of things, can we realistically do that? And what needs to be in place for us to be able to achieve the stability that we are seeing?
Great. It is possible. Looking at the trajectory in terms of inflation, growth, and interest rates, for over 15 months, we were able to keep our grip on inflation, pushing fueling disinflation for over 15 months as a country.
Yeah.
So what really stops us from doing that in coming?
Mind you, the things that, I mean, the injections from BOG and all of that made us record some of these numbers we are seeing are not going to be able to be done in the coming months, because BOG recorded some losses. I stand to be corrected. How do we maintain this going forward with the losses that BOG has incurred?
So I think I won't like to go much into the losses with the BOG side, given the dynamics around it, right? But what I can say is that from a policy perspective, right, the BOG still stand firm to, support, should I say, macroeconomic dynamics from the monetary perspective to complement what government is doing on the fiscal side, right? So going forward, you don't expect the BOG to still do the 10 billion, the billions of dollars in injections in the FX market, right? But I mean, you have a central bank which is trying to correct the fundamentals in this market. Trying to consolidate our remittances, making sure that the FX we gain as a country, they stay in Ghana, and so that we can use it to fund our import and the likes, right? Yeah. So I believe we had a fundamental challenge that took us into that situation that caused such heavy lifting by the central bank. And so if you are solving those fundamental challenges, then I don't think you still need to be doing that heavy lifting like year by year.
What are the fundamental challenges?
I mean, the leakages in the FX market and also, the whole foreign exchange market, and even how we consolidate our foreign exchange gains. I give an example. Now, we have the gold board, which is going to handle our gold, our gold export. I think it now becomes the sole entity to handle gold export and the likes, So that helps us to consolidate gains from that segment of the market. Now, maybe I should put this in better context. Imagine this amount of this value that we are getting from gold. Like last year, we made billions in terms of export from gold. Now, if we didn't have that structure that consolidates that gains for governments, that meant that we're going to have this FX gains in the pocket of other people, which will not be to the overall benefits of the country. But we now have this structure in place that would help going forward. You get it? Yes, great. So that's one example on that front. So when these fundamental challenges are solved, and the issue of BOG having the rates, Abuchi having the dollar, solving these fundamental challenges will help keep the FX market afloat. Yes, we are not.
All right. So let me to you, Nelson. Now, is there anything you want to? You are done, right? Yeah. Okay, Nelson. Is there anything you want to add to that? The same questions.
Well, I think I entirely agree with Mark. Uh, and there are still fundamental issues within the market that has to be addressed. But I think the best foot forward or the best way to go about it has to do with the enforcement of Bank of Ghana regulations. You know, I kept on saying that if you read Section 3 of the Bank of Ghana Act, it gives the Bank of Ghana a primary mandate, and that primary mandate is to maintain price stability. And then when he went on to Section 4 in the other section, he also talks about certain secondary, functions of the central bank, which has to do with maintenance or maintaining currency stability. And Bank of Ghana can only do that through enforcement of its rules and regulations and directives to the market. I mean, last year, if you recall, there were so many directives from the Bank of Ghana to the FX market. One of them I recall was when you go to the counter to withdraw cash deposit or whatever, no transfer into your account, foreign currency account, you'll be paying, is it 10% or 5%? This is a policy intervention that the Bank of Ghana wants to use to dissuade people from withdrawing dollar from the counter and sending it to Abochi.
All right.
You get it?
Yeah.
Because at the end of the day, when you go to the counter to withdraw money and they charge you 10%, and you take the dollar, when you take it to Abochi, you will get lesser than if you exchange it at the bank rate. You get it? So some of these interventions are very, very important in order to maintain the sanctity of the FX market. Right. Now, last week, there was so many news in the media that, the CD is still under pressure because there was not enough intervention from the central bank. And I even recall the central bank issued a statement giving a clear indication that they have enough FX to support those who actually need the money. So I think that from time to time, Bank of Ghana needs to actually come up to enforce its regulations so that we can have enough FX within the official banking system, so that these Abochi guys will not take advantage of it. Because even if you look at the spread between the Bank of Ghana rate or the interbank rate and that of the Abochi guys, the spread is just too much. And then if you take the Forex Bureau, their rate and that of Abochi, you see that the difference is too much. So we need to make sure we try as much as possible to dissuade some of these operations. Every country has what we call a parallel market or black market. Every country has it. But we need to try as much as possible to dissuade the Abochi gas from influencing the price. Regarding the buffers, yes, it's very, very important. And the reason why I mentioned earlier that I'm so happy that a legislation has been given regarding the gun wrap. And so that is what is giving, market players and the business community some level of comfort that, because this is purely, is being backed by legislation, we should be able to build enough reserves. Right. And those reserves should be organic. Okay, in the past, what normally happens is that we go and borrow and use that borrowed fund to build our reserve. So it was not organic. We were just renting the reserve. But now we need to own the reserve. We need to build it organically so that, we don't have to go and rent it anywhere.
I see. So still on the whether we can realistically maintain our fiscal discipline, where do you also stand? Mark Jordan talks about where the numbers are today, compared to where they were in the previous times where we went back to the IMF. Where do you also stand in that? I think you mentioned discipline earlier.
Yes.
As one of the
things. I still believe that looking at how volatile and highly political these economic issues are, and these issues are very, very important when it comes to election, I still have confidence and believe that the current managers of the economy, the Finance Ministry and the Bank of Ghana, will still maintain that prudence as they have done for the past 15 or how many months they've been in power. This is because we cannot always continue to go back to the IMF when they are out of town. So in terms of discipline, I personally have the confidence. Recently the government passed the Value for Money, Act, establishing an office to actually check, monitor the pricing or procurement related issues of government. And this is very, very good because in the past, one of the factors that actually short up government expenditure has to do with overinflated contracts. You remember?
Yeah.
Overinflated contract. And so once this Value for Money office is established, we expect that every government procurement related contract will pass through that office. They will vet it. They will know the actual cost of whatever the government intends to do. And I am sure that with the establishment of this office, fiscally, we can make some savings in that regard. We can make that regard. And there is also another comfort coming from the government, which has to do with the coordination between the Finance Ministry and the Bank of Ghana. You see, in the past, we haven't seen that level of coordination. You get it. The Finance Ministry will go and borrow. The Bank of Ghana will report the figure, and then when things go haywire, then the Bank of Ghana must step in to start correcting whatever. But we have seen that level of policy coordination, and that is how it's supposed to be in every country. I mean, fiscal policy, monetary policy, exchange rate policy, structural policy, all these policies must be coordinated. You see, if we are all working independently, we are not coordinating our efforts, it will mean that somebody will go and mess up somewhere and another, entity will be compelled to actually correct that. And so policy coordination is very, very important, and we have seen that also under this government. So given all this background, I believe strongly that going into the future, we will maintain the fiscal discipline and then continue to sustain the gains that we have made.
Now, I see that you have a lot of confidence in this, the current managers of the economy. My question is, what happens when they are no longer in office? What happens in that particular situation? And also, how do we make sure that there are things in place that will not take us back to IMF even after this government?
This is a very good question. This is a very, very good question. And this has been the problem of this country. This has been the problem of this country because one government will start a policy, which is a brilliant one. Another government will actually come and say, okay, we are not interested in this. And for me, reason why I mentioned earlier that the GANRAP program of policy, which has been given legislative backing, is very, very, very good. Because if any government wants to come to power and cancel that or repeal that act, it must go through Parliament. And I'm sure it is not only Parliament that will have a say. Civil society organizations, trade unions will have a say, students will have a say. I mean, ordinary Ghanaians will have a say. And so for us to maintain some of these brilliant policies into the future, what we must do is to try as much as possible to give it some legislative backing. So that when a government comes, it will be very difficult for them to actually repeal it. If you recall the one district, one factory, all this program, Agenda 111, I mean, government will come and say, okay, fine, we are not interested. Then it means that all the taxpayers' money that we have sunk into this project, they will go, wasted. And so we just hope and believe that when power changes or when new administration takes over, they will continue to implement some of these brilliant policies for the stability of the economy and for the benefit of consumers, business, and investors in general.
All right. Okay. Let me come back to you. But just before that, let me announce the phone lines in case anybody wants to join the conversation. So if you just tuned in, this is Business Breakfast on Zed 101.9 FM with me, Trevi Hammond. And this morning we're talking about our exit from the IMF program and whether we are able to sustain the stability that we are seeing in this country or in the economy. You are free to join the conversation. Send us a WhatsApp on 0544 and I'll read your messages for you. You can also call us on that same number or call us on 030395661 and then we'll give you the opportunity to share your thoughts with us this morning. We're streaming live on Facebook at ZFMGH and on YouTube at Z Multimedia. Please feel free to drop a comment and we'll read them for you as well. Let me come back to you now, Mark Jordan. Now, let's move on and talk about investor confidence. I think you mentioned it earlier, or was Nelson? I'm not too sure, but one of you mentioned investor confidence as one of the things that will be restored or has been restored, basically. Are we really at that point where we can say that investor confidence is fully restored? It's being it's fully regained in this country, both locally and internationally?
I think that's a great question. And I'll start from the local perspective, right? And then move into the international perspective. Because, these two guys look at Ghana in two different lenses.
Right.
Yeah. So I think locally, right? To some extent, about 80% restored from the pre-macro downturn, right? And I say that given how investors are placing money on the market as it stands now.
Right.
With what we are seeing in terms of T-bills dynamics, government missing targets and the likes, these are dynamics that do happen, given liquidity levels in the market. So one of the gauge is to check how long investors are willing to hold, government securities and how they are able to extend their maturities in government securities and the likes. Right, it's a good indicator of confidence in the government, right? And looking at how the dynamics has been so far, I think yes, we've been able to achieve about 80% confidence restoration.
Okay.
You check the bond market where long-term, long-dated papers are traded. When we went into the downturn, and I think in the earlier years of the IMF program, look, it was hard to even see about 100 million in volumes traded on the bond market, right? But as I speak to you, yes, we've seen considerable improvement.
Right.
I would say that trading activity on that end has, to some extent, returned to the pre-IMF program levels, with weekly turnover now comfortably about like $1 billion on that market. But when we went into the downturn, the market was highly at the short end, with investors, just trading the treasury bills, because you were really uncertain on what the future was like, right? So I think that dynamics give a sense of confidence, and not also switching into the equities market, right? I think same is also for the foreign guys.
Yeah.
We've now seen some foreign participation in the market, but yet again, their confidence is still around the currency, which takes time to build.
Right.
Yes. So that will take some time for them, and it's quite understandable.
Okay.
And even beyond the fixed income market, into the equities market, which is highly, should I say, risky and quite long term. If you check how confidence has been able to build up in the equities market, with weekly volumes now above macroeconomic downturn levels, right? And also one important indicator is how comfortably investors are willing to place funds or participate in initial public offerings by these companies, or how confident these companies are even able to look into the capital market to raise funds. Because usually when confidence are down, you see investors running to save, having demands. So for you to see investors coming out of this shell to go into risky assets with improved risks compared to treasury securities, it gives some level of confidence on that front. Because in the last, I could say, in the last 12 months, we've been able to record about 3 IPOs on the capital markets, and that's a good sign of confidence.
Right. So, but what risks could actually derail that confidence?
I think that's what we've been all talking about all this while, and it's about the fact that are we able to sustain the gains we made from the IMF program? Are we able to keep fixed income rates at its optimal level? At its optimal level, I don't necessarily mean always declining, because these rates they reflect true market dynamics. You are pricing in inflation, you are pricing in other risk premium, default and maturity risk premium and stuff. I don't want to sound technical, right? So how well are we able to balance it at an optimal level so that other markets can also see boom, like the equities market, Yeah, so that's literally it going forward.
Right. Okay. Let me come to you, Nelson. Do you have anything to add to that?
Well, I think he has said it all. He has said it all. The dynamics in the market currently shows that investor confidence is actually bouncing back.
Okay.
I mean, if you look at the Ghana Stock Exchange Composite Index, I mean, they are doing very well. Market capitalization has also shot up. Yeah, if you go to the Ghana fixed income market, I mean, per the report from the market, I mean, volumes have been going up. And so clearly we can see that, I mean, investor confidence is actually bouncing back. And even the government itself, the attitude of government, I mean, since they came, they've been able to honor all their debt obligations as and when they fell due. So clearly, I mean, that is what investors want. They want to give you their money. When the time is up, you give them their money back plus interest. And so once government is able to do that, and also inflation is not eating into their returns, they are okay. So we can conclude that, yes, investor confidence is bouncing back, but there is still more room for improvement.
Okay, I'm looking at our time, and we have to be wrapping up very soon. We saw the levels of debt that we recorded. I mean, previously, before the IMF came in and all of that. Nelson, and I'm coming back to you on that. What do you think are the biggest lessons we should take from that level? I mean, that's debt crisis experience that we had.
Okay, number one, I've always been saying that no country can say they will not borrow. Even at micro level, at you and I level, Charlie, sometimes you are cash strapped and you have to call few friends to sort you out. So no country can say, oh, for them, they will not borrow. Borrowing itself is not a bad idea.
Right.
But you see, when you borrow, you must use the money at a governmental level for projects that can generate positive NPVs. And so you don't borrow and use the borrowed fund to pay salaries for recurrent expenditure.
Right.
And we have seen parts of that in the future.
In the past.
Why, yes. I mean, you borrow from the international capital market and you use part of it to pay recurrent expenditure.
Yeah.
I mean, once you are doing that, you are shooting yourself in the foot, because, see, when you borrow and you use the fund for capital expenditure that are self-financing, then you know that, okay, this money I have taken, I have a reliable source for the repayment. Do you get it?
Yeah.
And so, for instance, if you take the Accra Kumasi Expressway, if government decides to borrow money to fund that project, and that project, that road will be tolled, then it means that government shouldn't worry themselves as far as the repayment is concerned, because they will use proceeds from the usage of the road to finance, the facility. And so we must always make sure that we borrowed to finance projects that can generate positive NPVs, of course, so that the repayment will not eat deep into our tax revenue. That is why anytime budget is presented, the first thing I want to look at is what percentage of our tax revenue are we going to use to pay debt or for refinance interest payments. In the past, we've been using more than 40% or 30% to do that. You get it?
Yeah.
So every one Ghana city that you mobilize as tax revenue, you use about 30 pesos to pay debt. That is not sustainable. You see? it.
Yeah.
And then one good thing that I mentioned somewhere is that apart from the 2.7 billion bonds that this government has issued, they haven't gone international. So which means that exchange rate volatilities may also not really impact on our debt position. Currently, we are, I think, around 45.3% as at the end of last year. And so we are hoping and believing that it may not shut up, because anytime your debt becomes unsustainable, and that is where the problem begins. And so regarding our debt, I think that we need to tread cautiously. The government has had a lot of footprint within the treasury bill market. That is normal because even now the rates are very low. A reason why for some time now they've been, recorded under subscription.
Right.
However, I still think we need to tread cautiously, not to blow our debt position up, and that will come back and bite us as a country.
I see. Right. Oh, maybe finally on debt, and then we can give our final thoughts. Do you have anything to add to that?
Yeah, I think that's what Nelson said is right. Just what I'll add is that we keep like very optimal external debt levels, because when you check one of the challenges that took us to the IMF, our external debt levels was a considerable part of it.
Right.
When you have very high external debt levels and then your currency position start dwindling, it starts, increasing your debt position at that front as well. So I commend the government for what they've done so far, staying out of the international capital market. I hope that we keep it at optimal levels going forward. And should we even embark on such trajectory, we will be expecting that such funds will be deployed into high-yielding investment infrastructure projects.
Right. Yeah. Right. Okay. So as we wrap up, maybe your final thoughts. I'll go to Nelson and we wrap up in studio. What exactly must Ghana or government begin to do or avoid if we want to break the IMF cycle? That's my final question to all of you. And Nelson, I want you to take your bite, and then Mark Jordan wraps up for us.
Well, I think we've said all already. That fiscal discipline is key.
Right.
Yeah, because that was what actually took us to the IMF. So once you are managing your economy in such a way that you keep on borrowing, then the time comes for us to go back and borrow and people are not interested, then certainly you have a problem. And so we have to continue to be on the path of fiscal prudence in order to sustain and maintain the gains that we have made into the future.
Right. Okay, Mark Jordan, you may want to add to that?
Yes, I think when you check the cycle, right, I think about every 3.5 years after we have to, in a way, return back to the IMF. Right. I think it is kind of clear that with the current administration, and I say administration for a reason, because administration is quite different from the political party in power itself. This what we have is Mahama running and with his. It could be NDC in power, but it might not be Mahama with true. Other. Right. Yes. So at least with the current administration, like Nelson mentioned, we have some kind of certainty that we might not be going back to the IMF, and that's clear. So what happens thereafter is how we really manage our debt levels. Right. And then how we're able to mobilize revenue. That's still a challenge. Right. Ghana recently became 8th largest economy in Africa. But yet today, still, our tax to GDP is one of the lowest in the region. Right. So we'll have to really beef up on that end so that we lower the chances of borrowing. And I think with that in place and sustaining the current momentum, we should be able to stay out of it for long.
All right, gentlemen, thank you very much for your time. I'm really grateful for having the two of you this morning to talk to us. So Nelson Kujo Kwagbeji is a financial analyst, and Mark Jordan Tika Nate is a senior research associate at La Rosa Africa. These are the two individuals who joined me this morning for our roundtable discussion. We've been talking about Ghana's IMF exit and whether we are able to sustain that. And I think it's been a very good conversation. The point is that we need a lot of discipline. We need to also put in place the right legal things so that we avoid running back into this when government changes or when administrations go and others come. And so, very important conversation. If you miss any part of it, you are free to visit our social media platforms. We're on Facebook at ZFMGH and on YouTube at Z Multimedia. Please visit and you can play back. All right, so that's our wrap up today on the Business Breakfast on Zed. We're back again tomorrow for some more interesting conversations. Until then, please keep listening to Z 101.9 FM. My name is Nitra B. Hammond. When you think Ghana, think Zed. Up next is The Brighter Side with Jeremy Okori Amwako. I'll see you tomorrow. Bye bye.